Welcome to the Dividend Talk podcast, episode 248. 5 global dividend machines with DazMikey. Hey everyone, this week European DGI is on vacation. He's away sailing the seven seas and enjoying his vacation. But I've replaced him with another good Dutch person. And today I'm joined with DazMikey. Welcome to the show, Daz.
Thank you very much, Derek. Glad to be here.
Yeah, I mean, you're not new to the show. You've been on this before. You were on as a guest. This time you're now joining me in replacing European DGI. So you have to be unsalted. You have to give your Dutch opinion and follow in his footsteps.
Oh my God, those are big shoes to fill. Oh my God, the pressure.
Yeah, huge pressure. Hey, but you're well capable of it. Thank you so much for joining me. I know we chat quite a bit on Twitter and X and other social media about football, and actually the topic of this show was probably influenced by some of our conversations, because you'll always ping me with these companies, these random companies, such as TDK. Have you ever heard of this company? So I thought, why not do a show on global dividends? Maybe stay a little bit away from our niche, which is America and probably more Central Europe, or at least Ireland, England, Netherlands, French companies. So we try to do something a little bit different. And while researching for it, we found all these companies in your portfolio. So I'm looking forward to talking to you about them, getting a little bit more insight into these types of companies, and I'm sure we'll have a great chat on that. But hey, look, you know the layout of this show. Was there any news this week that caught your eye?
Well, true. One of the things that we all noticed probably is last week we were all talking about reaching new all-time highs,
Yes.
and suddenly this week it's all depression and it's going down, 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 down. And it started all with like this Moody's that cut the AAA status of the USA, which cut us down already, and then Trump started his whole show with his tariffs. And yeah, what do you think about it?
I mean, it's like a circus at the moment. You don't know what's going to happen. I mean, Moody's cutting the credit rating was quite surprising. I think it's the first time that since their inception that America's credit rating has been cut. It's probably not surprising considering the amount of debt that they have on their own balance sheet. And I think this federal deficit is expected to grow at around 9% per year up until 2035. Now that's an estimate, of course, but I mean that they're just crazy big numbers. We know it's the world economy. We know it's a strong economy. But I mean, if you're looking at this from an investment point of view and you're looking at the amount of debt they had on their balance sheet, man, you would not touch them.
Yeah, I mean, if the amount of debt fits an economy that's like in a big crisis, and that's the whole point. They're not in a big crisis yet. Everything seems to be going pretty well. So why the big debt levels work on it, USA? Come on.
Yeah. But look, they have big expenditure. I know there's a lot of calls for reducing, say, military expenditure and so on. But they're in a tough spot. I mean, they are the leading country in the world. They have to have a good military. They have to give loans to so many other countries. They do a lot of that kind of stuff as well. So they're in a difficult position, but I can't see it ending too well the way it's going like this. And then you have Trump in the middle throwing tariffs around. I know we didn't quite mention it yet, but he threatens Europe again with 50% tariffs. He's threatening Apple with 25% tariffs if they don't make their phones in America. He then extended that invitation out to Samsung, knowing that they make all their components in South Korea. So, I mean, I don't know. Are these tariffs working? Are they not working? It's hard to know.
Well, yeah, I mean, he's creating a lot of chaos, and the markets just don't like chaos. Uncertainty is killing for markets, and that's probably what's leading to all these stocks dropping in share price. And I don't know if you noticed, but did you see the renewables this week and what they did?
I didn't. I saw what you posted here, and I was looking at it, and it's yeah. I know America is slightly different in terms of its targets than Europe, so it's hard as a European to understand this. But I mean, he's just basically doing anything that President Joe Biden did beforehand and trying to destroy it.
Yeah, they're not really big friends, those two. That's for sure.
Yeah.
Yeah, I mean, I ended up buying Enphase, which is one
Okay.
of those stocks that's been pummeled by the tax bill that he put down. Um, I mean, it could hurt up to like 50% for these kind of credits that they were getting. So it's a material for these type of companies. So First Solar, ENPH, Sunrock, Run, those stocks went down by like 20%, 25%. So that's substantial.
Yeah, of course, and look, his his tax bill here is to wind down the tax credits that these companies receive, and I'm not so much involved in solar or renewable energy in the US, but I am heavily invested in, say, the UK and Europe. And the main reason for that is because Europe have quite aggressive targets, whereas I know America are probably a little bit more relaxed than we are. But the problem with these types of companies, and this highlights it quite well, is that you are tied to administrations, to governments, to their funding, to how they think. So you are kind of caught. And if you're overextended at all, or if you're laying all your eggs in the basket of waiting for these credits, and someone like Trump comes in and takes it away, then you are very, very exposed. So yeah, it's going to be a tough couple of years for some of these companies, I think.
Yeah, but to end this on like a positive note,
Yeah.
especially for a European country, Equinor, they
Yes.
were
Yes.
heavily invested into a project called the Empire Offshore Wind Project. I think
Okay.
it's near New York. And Trump basically said, stop, even though, it was already, how do you call it, licensed and stuff. So they already started working, building up these windmill parks. And now suddenly they decided to let them go on again. So the stop work order is cancelled. So Equinor now can start building their windmills.
Hmm. And do you know what drove that reversal in that order?
I have no clue.
Yeah,
That's the
and
whole point with Trump. Sometimes he just says drill, baby, drill, and does as he like.
yeah, I mean, I wonder if he actually sits down to think about some of his actions. I mean, you have this energy wind project, and look, I don't know a whole lot about this, but I know that it's expected to power over 500,000 homes, which is not insignificant. I know it's a small number in the United States, but it's not an insignificant amount of energy that it's producing. But wind energy and solar energy and renewable energy can also help stabilize the actual electrical markets and take pressure off what I mean. If you even look at European markets, you can see the stress on all the electrical grids at the moment is tremendous. And I know renewables can be a little bit not as predictable as predictable to some measure, but there is a level of unpredictability there. But they do help keeping those grids ticking over. So I'm glad he's lifted that stop order, and it's good for shareholders of Equinor as well. But it just shows to me at the moment that if you're in this renewable space and you're in America, you need to have a good look at yourself over the next three years or so until Trump is no longer president, because it could be a bumpy ride.
Yeah, well said, well said.
Yeah. So let's move on to more positive news, will we? We talk about some dividend hikes. Who doesn't like dividend hikes? And we'll start with Medtronic, good old fashioned Irish company. Um, Medtronic hiked its dividend by 1.4%, which gives it 48 years of dividend increases, which is not too bad, I would say.
No, it's pretty impressive. It's just it's not very high raises lately, huh?
Yeah, the business has been struggling. It's kind of low growth, and Rafa, who's a prominent member in our community, I would say, also posted some news on our social media platforms about Medtronic's intent to separate their diabetes business into a new standalone business. And I don't know the details offhand. I actually didn't get to read the full article, but to me, that kind of makes sense, I would say. Diabetes, I would imagine, is probably going to be a faster growing business, or at least there's more and more people in the world getting diabetes with all these sugary diets that we now have. So, do you have any thoughts on that? Or
I have some first-hand experience with that. I once had one of those monitors on my arm, that
yeah,
monitors you daily your sugar levels, and yeah, I was pretty impressed by it. It was a positive experience, but um, to be honest, I have no clue how big their diabetes business is and how material this separation will be. But it makes sense, it's an interesting business. It probably will grow faster than Medtronics is right now.
Yeah, Dan, that's what I'm thinking. And like you said, I've never had diabetes, but I have a close friend and his wife and his child have it. But what they have now is they have some sort of patch, and you can monitor the levels on your phone,
Right.
and also with a pump installed, and it automatically then puts insulin in or adjusts the levels where it needs to be. It's quite amazing. So there's a lot of tech involved, and a company like Mentronic would be perfect for this type of thing. But yeah, I just thought it was interesting to share Rafa's news. We got some decent dividend hikes then from Northrop Grumman. Grumman, sorry, ticker symbol NOC. Now, we spoke about the military spending of the US, and we can see its prowess here
Hmm.
with a 12.1% dividend hike. And that brings their dividends up to 231 per share. Lennox International with a dividend hike of 13%. A company that's contentious, well, at least on my side, a lot of people seem to like it. It's a high yielder, but Lydell Basel Industries, ticker symbol LYB, increased by 2.24%. And what's your take on this company?
Uh, I used to own it, but I sold it. Um, I mean, it's a high yielder, so at 2.24%, I would be happy getting that raise. You know, I don't expect big raises when I own a company like this because they're already paying out a lot. But the reason I sold it is the kind of business. I'm just not too happy with the risks involved with these type of businesses. You know,
Yeah,
um, all these chemicals, and I, I heard the news in I think it was in Belgium some time ago. You know, with some of their product coming into the waters, and I don't know, it's too risky for me, so I decided to sell.
yeah, I was the same. I did own them before as well, and I sold them pretty much the same reason. It's a hard business to understand, and look, you're dealing with gases, and I know they were involved in Russia and probably some in Ukraine, but more so Russia at the time. And they nearly went bankrupt. So it's a quite a cyclical company, and it has previous. So, but look, I know a lot of our community like it. It is a high dividend yield, and with a 2.24% dividend hike on top of that, it's not too bad. There's a couple of other companies here. So Richard on Facebook mentioned Flower Foods. They increased the dividend by 3.13%. Ralph Lauren, which is a luxury brand, increased its dividend by 10.61%. Marriott International, which probably is a hotel chain, increased their dividends by 6.35%, and Nasdaq increased its dividend by 12.5%. I mean,
Wow.
some pretty strong dividend raises there. And Nasdaq, these types of companies interest me. Like I've studied CME, London Stock Exchange, and I'm going to slowly make my way through the list. I think Euronext is going to be on my list next, but 12.5%. These companies are just compounders, aren't they? There,
They're on fire. You know, I would encourage you. You know, maybe you can make an article. You know, just compare a few of those.
yeah,
They're each of them are raising their dividends like crazy. It's
yeah.
amazing.
It's mad. Like, and every time I look at one, so I look at London Stock Exchange Group, and I'm like, oh, I love this one. I love this one, and I forget about the rest. And then someone else mentioned another one. You're going, oh. So I'll end up buying them all. I would say if I keep reading about them, but
Yeah.
it's good. Marriott International was surprising, 6.35%. I stayed in one of their hotels in Rochester in the US of A, and let me tell you, I've had good experiences with their chains, but the one in Rochester was was an experience. It was quite quite haunting, I would say. But
But was it a good way to spend your dividends?
no, no, no. But hey, look, it was a work trip. They put me up there, but it was usually we don't stay there. We stay at a different hotel. But the PJ tournament was on at the time, so we could not get anywhere.
Mm.
And this was the only hotel left, and there was a reason for that. Let me tell you, there was a reason for that. So I won't go into specifics, but I think overall the chain is quite strong. It's quite well known, and hotels that I do like to stay in. There has been some dividend cuts, and two of them that I know of is Crown Castle decreased its dividend by 32%. So it decreased from 156 quarterly to 106, which I don't think that was too surprising. I think people have been talking about this coming,
Yeah.
if I'm correct. And also National Grid decreased their dividend by 1842. We spoke off air that I thought this was announced way back with the interim dividend in November, but you were a little bit more meticulous than me. You did some reading and you found the real reason behind that dividend cut.
Yeah, I did not even use AI for it. I used old-fashioned Google, and I found a nice write-up about it. And it says that on page 89. So you need to dive deep to get this. And of the results, it said like as part of the rights issue, the board announced that the overall cash dividend level would be maintained, with additional shares from the right issue resulting in a reduction to calculate dividend per share. So in the end, they did not really lower the dividend, but they
Yeah,
added more shares. So the dividend per share was going down.
yeah,
So, I mean, you're already having a rights issue. So, and then on top of that, you also get less per share dividends.
yeah. I
Sucks.
mean, you're diluting the share base. So if you own National Grid, the portion of your shares are worth less. And now, technically, they can say they did not cut the dividend in terms of the cash amount paid. So if you look purely at the cash flow statement and you look at the amount of money they paid, you will say, they've kept the dividend flat. But actually, because they own a lot more shares, it resulted in an 18.42% dividend cut. So that was a good catch for you. I have to say, I laughed when you said about you did not use AI. Last week, European DGI mentioned that he doesn't use AI for certain things on annual reports because he can find it quicker. And I got some funny comments on YouTube and emails about European DGI being faster than AI and ChatGPT. I thought that was quite funny, but yeah, it's the way forward. I mean, AI seems to be on everyone's lips, but I try and stay away as
Yeah.
much as I can at the moment.
Maybe you should change his website to like .ai, like European investor .ai.
Yeah, yeah, and all the models be based off him. They just ring him up. He'll just answer straight away. Boom, gone, done.
Exactly.
Yeah. Quickly, then we have a couple of earnings that we wanted to touch on before we get into our stock safari, which I'm looking forward to. But the first one was Target, and Target is an interesting one. I have a small position in my portfolio, and they are trading, I would say, would be undervalued at the moment, particularly when you look at their earnings. You look at their earnings per share and PE ratios. Again, they've had a really tough quarter. Their sales overall was down 3.8%. Their overall stores comparable sales was down nearly 6%, although their digital sales was up 4.7%, but that's smaller compared to its retail sales. This gave them a gap EPS of $2.27. I mean, they are struggling at the moment. There's lots of things going on. They've got a weak consumer. They lost a lot of consumer confidence when they were doing this DEI initiatives, which they've now pulled back on.
Mhm.
So any consumers they would have got from those initiatives, they've lost, and any ones they've lost doing those initiatives have not seemed to have come back. Then you've got these tariffs coming in. It's putting pressure on their Chinese imports. They're now trying to push, say, more low cost brands or low cost products in their stores, which is not always a good thing. But they are under a little bit of pressure, aren't they?
Oh yeah, it's almost like a perfect storm. And I think if you compare them to Walmart, then they're probably in a bit of a pickle. I
Yeah.
mean, I get the feeling that Walmart is probably better capable of keeping those margins, although they are also under pressure. So it's going to be an interesting thing to follow.
Yeah, I think so. I'm kind of sitting there wondering. I have to look over my business case and my investment case, but you have to like these are the times where you need conviction with these types of companies, and I struggle as European because I'm not in America. I don't know the sentiment around it, and I know maybe I go back 2 years ago, even during COVID, even kids in Ireland were talking about Target. It was all over YouTube and TikToks and all these. And when I spoke about Rochester. Actually, when I went to Rochester, my niece, all she wanted was a bag from Target. Like that's how crazy it is. Whereas that sentiment is completely gone. Nobody's talking about the company. And as a European, I struggle with that a little bit and in my conviction a little bit compared to say someone like Tesco in the UK or Ahold Delhaize, which are European and it's easier to get a feel for it. So it's definitely interesting times to follow. And comparing them to Walmart is a good yardstick as well. But what about some European companies? I think you had a brief look at Hornbach.
Oh yeah. I'm a shareholder. I think
Oh, nice.
European DGI is also a shareholder and pretty vocal about that he likes the company.
Yep.
So I've been looking at it also because it's very interesting to see like how's the consumer doing in Europe, because how are they holding up? And when you look at the numbers, they're not that bad. Nothing to cheer about. The net sales went up by like 0.6%, so kind of flat. The earnings were up by about 6%. And for the outlook, that's what caused a lot of people concern. But because the stock went down about, I think, 8% on the day that the numbers were reported, Wednesday. So the outlook there were not received well because basically everything stays flat. Earnings, sales are expected to stay flat, maybe rise a little bit because of new stores, locations being opened. But overall, I'm not too unhappy. I hear everywhere that like the German economy is not doing very well. At least they're not dropping like a rock, you know.
Yeah. Yeah. I mean, you got to remember that this is a DIY store and it's going to be a little bit cyclical, especially when we have a bit of a weaker consumer at the moment than normal. But I mean, you say the stock was down 10%. I remember European DGI doing this article, so we did a deep dive on them. They were trading at around $70. And after that, before he released the article, actually, I bought some shares as well. But I checked just before the show, and they were over $100 at some point. So
Oh yeah, I think it's quickly
€100.
recovered. It recovered
Euro.
quickly. It was like down and then went up a bit, and it's not too bad.
Yeah, yeah, nice,
I'm a
nice
happy
company.
shareholder still. So
Yeah, I think these founder-owned companies are doing pretty well in Europe, and I think that's why European DJI likes this company so well. I expect a couple of years of flat earnings from them, but nothing to worry about, I don't think, from my end.
I think it's a quality company. They just got very annoying commercials.
Yeah, yeah.
You know
I,
those?
I don't get to see them. Obviously, they don't have Hornback over. Well, yeah, we don't have Hornback, so we have B&Q. We have probably a couple of Irish ones. We don't have Hornback, so I don't have the luxury of listening to these commercials.
I see there's room to expand. That's good.
Keep their commercials. That's what I'm hearing. Nice one. So we're here to talk about 5 companies from around the globe. So we're going to pick areas that we wouldn't typically talk about on this show. And the first one, so I put this question out on a couple of social media platforms, and I think I got over 40 or 50 stocks, and we can't obviously talk about all of them. There's so many good ones, but one that caught my eye was there was so many Slovenian companies mentioned. And there was a couple of comments afterwards saying these are all strong companies, and it's not an area I ever looked at before. Now, the first company on that list that really caught my attention was in the healthcare, and it was KRKa, is the name of the company. And I know you owned them at some point, so you might know a little bit more about what the company do, how they make money, or just a little bit about them.
Oh yeah. I've owned them, like you said. I think I bought them at the Polish stock exchange because
Yes, they're
that's where
trading
they're
on the
listed.
Polish Stock Exchange. Yeah.
They're originally from Novo Mesto in Slovenia, and they're big in generic pharmaceuticals. So basically, they sell this stuff all the way from southern, eastern Europe, like say from Greece up to Russia,
Yep.
but also Middle Eastern countries like what have we got, Austria and stuff. So this is about the area where they are selling their products. And what the amazing thing about them is that over the last couple of years, they've been managed to pay out about 5% in dividend every year. And they've been growing that by about 13.6% a year. So I can imagine that is what caught your eye.
Yes, yes. I mean, and they're quite vocal about that because on their investor presentation, they have a slide and they show their gross dividend per share. So in 2015, it was 265. Last year, it was 825. So, I mean, we're seeing nearly a 4x increase, 3.5%, 3.5x increase in terms of value. But they also have a graph underneath that shows the average yield, which is
Oh
around
yeah.
4 to 5%, and their average growth. And you look at that dividend CAGR over the last 10 years. I mean, 12.7% of a company that's yielding always around 4 to 5%. I mean, we talk about chowder reel, but this is off the scale.
So you see this graph, and it starts like in 2015, and
Yep.
it's the yield of the year. It's a 2.65 euros of dividends gross, and then you see this graph going up. It's like chart porn, and then it ends in 2024 with 8.25.
Yeah.
Now, if that doesn't make you happy, then why sell? That's what I asked myself when I looked at this. Why did I sell this?
Yes.
Yeah, good question. The thing is, back in the day when I sold it, this was at the time that the war started with Russia and Ukraine. And they were getting about 25% of their sales in exactly those two countries, 5% in Ukraine and 20% in Russia. And I was like, okay, let's look up some news about this. How is it going to affect them? And I found, and this is one of the things that you run into when you invest in companies like this. It's very hard to find news about the
Yes.
Slovenian company. Especially it's listed in Poland, but I hardly could find anything about it. So that's when I thought, okay, it's so hard to find any information about this company aside from like the annual reports, which look perfect, by the way. Um, it was too risky. I sold.
Yeah. Yeah. I mean, I'll be honest with you. I've never owned a company. I've only heard of them since we put out the post about this podcast. But knowing what I know now, even if I was to go back in time and I seen 25% of their sales came from those two areas, at that time, nobody knew how that would pan out, how that would end. There was a lot of uncertainty, particularly with Russia. There was a lot of sanctions. There was a lot of things happening. So I probably would have sold just for that risk alone. But then couple that, like you said, with the news. And it's probably one of the reasons why, I mean, I'm from Ireland. European DGI is from Netherlands, living in Poland. But that's probably why our universe is probably in that area. It's kind of closed because the news that we receive is going to be tailored to us. When we open up Google, it's not going to tell me about Slovenia, Romania, or any of that. It's going to stick to my regions, and that's probably why we miss out on some of these gems. But I look at this company now, and I'm like, I really want to own it in my portfolio. Like as you said, they're in the generics. I had Viatris before who were also in generics. I sold them because they sold their generics business. So this looks like a brilliant European replacement for a company like that. Prescription pharmaceuticals make up obviously the majority of their sales. They also got non-prescription products, but they have this little, and I don't know how little it is because I didn't deep dive into the company, but they've also got this animal healthcare part of their business as well. And if you look at what Pfizer did with their animal healthcare, they spun that off. We now have Zoetis, and that's just an incredible company as well. Like people love to spend money on their pets, and it looks like they have a little piece of the pie there. So to me, just scratching the surface of this company, it looks like a really well run company first of all, but one that I need to deep dive into because it looks like it needs to be in my portfolio.
Yeah, and what I remember from reading the annual reports, it was always very investor friendly, easy to
Yeah,
read, good graphs, clear policy. Also, it's not every company has a clear dividend policy. They intend to pay about 50% at least of their profits.
yeah.
So, you know what you're up for, signing up for. So it's probably something to look into.
Yeah, I had a brief chat. So I did my first podcast on someone else's podcast there recently. It was on Jeremy, who was also on the show, and he's heavily involved in our Dividend Talk Face group. And we were speaking a little bit about European companies and how we differ from US companies. And one of the points I made was around these types of dividend policies. With European companies, you know what you're getting because most of them, I'd say the majority of them, will give you a clear dividend policy. And at least I know that if they are growing their net profit, my dividend is going to grow. So I know where I need to focus. Whereas sometimes with American companies, I know actions speak louder than words and they have incredible dividend histories. But when shit hits the fan, as we say here in Ireland, when times are tough, you don't know where you stand. You're kind of hoping that companies are going to stick to what you believe their policy is, but you don't really have a clear understanding. So I certainly appreciate European companies when it comes to dividend policies.
Yeah, good point. The only thing that they could improve on maybe is the number of times they pay out. Let's say they say 50% and then pay out in like 4 steps.
Yeah.
That would be nice. Spread it out.
I don't mind, right? Because I look at May my May income, and I'm going to look at my June income, and I'm going to see on my chart this big spike, and it just makes me so happy to see that. And I know it's because I have so many European companies, but yeah, May, June, July, I just get this huge spike, and then the rest of the year, my graph just looks tiny because it's such a big spike. So, I mean, I don't know, I don't mind it, but I'm not living off my dividends yet. I think if I was living off my dividends, I'd change my tune pretty quickly. Nice. So you spoke about shareholder-friendly websites, okay? And the next company we're going to talk about is all the way in Japan, and it's a company I know from my engineering field. But I would not say its website is shareholder-friendly. I went, so I know a little bit about this company in terms of what they do, what they sell, their customer support, their products, how well they integrate, and how well they actually use their, I would say, sales engineers to try and help you develop products, right? And I mean, it's top class. And this company is Keyence, by the way, KEYYENCE. So, I mean, they're fantastic from that end. But I went looking on their website for like dividend histories and stuff, and I was like, man, this is torture. It was not easy directly on their website. But look, for those that don't know, Keyence, it's around since 1974, and they are mainly in the manufacturing, industrial automation, inspection systems kind of world, right up my street. So the products consist of code readers, lasers, vision systems, measuring systems, microscopes, sensors, static eliminators. And I can tell you in my day-to-day job, I use every single one of them. Not always from Keyence, mind you, but I use every single one of those types of products. So I know the company quite well. I've already mentioned what sets them apart from other companies that I deal with. They are excellent. I can go to their sales engineers with a problem, and they are on it. I mean, they are on it. They will come back with solution after solution after solution to try and help you. And even then, when you have a problem, their after sales support is top class. You don't get that from everybody. Let's put it that way. But Keyence are really really well up there, and it was nice to actually see that called out in their annual report. So when I did manage to find one and read through it, they do take pride in their customer support and their sales network, and I think it's one of their strongest features. Also, their R&D is quite strong. They always come out with new products. They're constantly updating their products, and I mean, I must get a call off their off their sales agents once a week or once a month at this stage, just to tell me about new products. But yeah, it's a really well-run company. But enough about the background. What about the numbers? Have you looked into the numbers of this? Is it worth investing in, basically?
Well, you can see that they actually try to get their business running because they have sales, because the sales have been going up like steady Eddie. I mean, it's like 12, 13%, like over the last 12 years. Every year, sales have gone up by about 12%. The earnings also 12 to 15%. So that looks really, really good. And if you look at their debt, I mean, it's more like what debt? It's perfect. The only thing you could say is like, okay, the yield is a bit on the low end. Have you seen how much they actually pay dividend?
The dividend amount, no. I know the yield is low, but I didn't know the dividend amount.
The dividend amount is about 350 yen, I think you say in Japan. So it's like
Yeah.
0.6%. So it's only a payout ratio of 21.3%. So, there's room left to grow that. We're talking about dividend growth. The last 3 years, 20.5%, 18% over the last 5 years, and about 21% over the last 10 years. Each year, 20%. That's
Wow.
crazy.
They are big numbers. And yeah, I mean, you look at this type of company and you see a dividend CAGR over 10 years at 20%, and you wish you owned them 10 years ago. No, don't you? Like
Yeah.
with those type of numbers.
I mean, if you would have owned this, as I looked at the graph that you also put down, and it looks like after 2021, it exploded. It went up real fast. So if you would have bought it back then, and you would look at your yield on cost, I'm sure you would be very happy.
Yeah.
Very
Yeah.
happy.
But I just struggle. I just struggle with low yielding companies like this. You can't expect a 21% hike into infinity every 10 years, which is where I struggle. But it's a company that I always say I'd love to own this company purely because of my experience with the company. But its valuation, its dividend yield just makes it quite difficult, and also where it's based. I don't have any Japanese companies in my portfolio, but yeah, I would be. It would be one that if it was trading at around maybe 1.52% yield, I
Mm.
would love to own it and have it in my portfolio as one forever. It's kind of, for me, Schneider is a really good company, but I would rate these ahead of Schneider in terms of experience working with them and products and so on. So interesting company for me.
Yeah, I actually have the same. This is just a bit too low for me. I mean, looking at their like earnings growth and their revenue growth, you could expect them to raise it for like 5-10% a year easily. Even maybe the next 10 years. So even on the conservative side, you could say that that's an expected minimum growth of dividend. I would say, if it continues like this, uh, but 20%, that's a bit too much to ask. I think their payout is pretty low, the ratio, so they can afford to raise it even faster than like 5-10% a year. Um, but I would still find it very. I mean, if you're 20 years old and you have like a long time horizon, to invest, it might be very interesting to buy a company like this. But with me, 45 years old, nah, don't think I will do that.
Yeah. Yeah, but look, everyone knows how bullish I am in this sector. I think industrial automation is growing, particularly machine vision sensors. AI has a huge part to play in all of this as well. It's really going to explode
Mm.
growth, and I can see it in my own workplace. So yeah, 20-year-old me would definitely buy this company. 40-year-old me is waiting for a slightly better yield, but I think it's definitely one to keep on the watch list. But nice companies. But we'll come back to Europe, will we? We'll come back
Oh
to
yeah.
Central Europe, and we're going to Austria this time, which is, I don't think we've ever mentioned. Maybe Vienna Insurance Group has come up before, but this company was quite interesting in your portfolio, and that is Verbund, VERBUND. So they're a utility company. What struck me the most about them is they make a lot of their money using hydropower. And I speak about my background as an automation engineer, but I'm trained in electrical engineering. So in electrical engineering, hydropower is something we would have learned when we were in college. Ireland actually had one of the largest hydropower units in the world back in the 1930s. Now it's small in comparison right now, but at the time it was quite large. So it's something close to our hearts. I've been to a couple of hydropower plants in Ireland, particularly the first one, which I said, which is Aaron Crusher. They're really impressive. They're just impressive things. So quite happy that you brought up this company, and I'm keen to hear your thoughts on them and what makes them an interesting company.
Well, yeah, it's one of those companies that is a bit harder to sell maybe than a Keyence or a company like that, because I mean it's a utility. Okay, there's a lot of people that don't like the utility sector because of regulation. First of all, there's a lot of regulated energy prices, of course. Um, a lot of government involvement. So some people are just saying, "Oh, that's a red flag on its own," for this
Of
kind of
course.
business. And when you look at Verbund, and the first thing you look at is their dividends. It's all over the place.
Yeah.
There are it's like 2.8 in 224. It's €4 in 23. It's 360 in 22. €1 in 21. It does not look like a steady Eddie.
No, certainly does not.
So that's why I say it feels a little bit like a company that's harder to sell. I think what attracts me, because I'm a shareholder of Verbund, is exactly what you say. Their hydropower. It's clean energy. It's reliant. It has good margins. So especially the last couple of years when the electricity prices in Europe went up by a lot, they were managed to sell that at really really good margins. So that's probably explaining why their dividend went up so fast the last couple of years, even though a large part of it is special dividends. Um, And I think that's one of those type of companies that is overlooked because it uses special dividends. I know you
Yeah.
did like an episode on that, right? Special dividends.
Yeah.
And a lot of people prefer the companies that are paying like a steady dividend, and you know, but there's some gems out there that do pay like special dividends and make it really, really attractive to invest in them over time. And I think this is one of them.
Yeah, two that come to mind is CME Group and EOG Resources. Oh, I quite like as well. But what struck me the most about Verbund was their revenue. I looked at their top line. And you see, 2020 it was around 3.5 billion. So yeah, not too bad. 2023 it was at 10.5 billion. You're like, wow, that's that's a big jump. But what these guys have managed to do is obviously cost of energy has gone up, and they've took advantage of that because
Yeah.
their costs didn't really go up. They're letting water run through these. I mean, I won't go into the technical detail. I'll bore you on this, but it's really cheap to manage and to do that. So they've managed to increase their revenues, keep their margins and costs relatively low. And we've seen the benefit of this then in terms of special dividends over the last few years. But I suppose the risk with that then comes with the normalization of electricity prices. So when this happens, now we could see that they've benefited from these margins over the last few years. So investors who are following these for maybe the last 2 or 3 years will be used to high margins, high revenue, low costs. And now we see this normalization of electricity prices, and the reliance on hydropower will not be as strong, and we can see these margins then coming back to a normal level, which I think is a risk.
Oh yeah, that's you're completely right. On the other hand, I'm a bit more positive maybe on the prices. We're electrifying all over Europe.
Yes.
The demand for electricity will be going up, and they're in a nice position, I think, Verbund, because they got the hydro, they got a lot of renewables to add to this. So basically, they're already in a good starting position. You know, they're not going to switch from gas or from coal and all this stuff. They already got like the clean energy going. I think the hardest thing here is that it's very hard to increase the number of hydroelectricity that you're selling, because you know there's just so much hydro that you can add. Like,
Yeah.
and to give you an idea, they are like the fifth, like Austria is the fifth biggest hydro producer in Europe. There's some other countries that are big in there, especially Sweden, Norway.
Yeah.
But it's I mean, I don't expect them to be growing in that area. They're probably growing in renewables in the next couple of years.
Yeah.
So yeah, that's what I like about them,
Yeah.
renewables.
And to give you just a little bit of flavor of the scale of what they can do is, so their largest plant is the Limburg 2 plant, and that generates around 480 megawatts. So that's its total capacity, all things being equal, and 100% efficient, 480 megawatts. So in theory, if you were to do the maths on this based on the average European electrical demand, you could supply 1 million homes per day with that. I mean, it's not insignificant. It's a large amount of energy that they can produce. In comparison, you have Ireland's largest, Thurrock, which is almost nearly under half. It's about 290 megawatts, so it's a lot smaller. So yeah, you can see the generation power that Austria has with these types of plants. So I'm not surprised it's the fifth largest. But like you, yeah, I love hydropower. I think with this energy transition and renewable energy space, I'm really big. I'm a big fan of it, I have to say, and this this is quite nice. I just think it's the uncertainty of the dividends. I know it's a special dividend, but I don't know if it's the same as, I would say, CME Group, who nearly always pay a special dividend. It's like clockwork, you would say. I don't know if it's in the same bracket, so I'd have to dig deeper into this type of company. But yeah, hydropower definitely caught my interest in the beginning. I was like, wow, I like this. I like this type of company.
Yeah, yeah, they're one of the few companies, by the way, that have a really good credit rating as well, like an A credit rating.
Oh,
So they got money to spend, let's say.
yeah, nice, nice. Should we go back to Japan? Japanese companies are
Oh
always
yeah,
quite interesting, and this one is TDKY. Corporation. And you pinged me on Twitter there last week, I think, asked me about this company. And what did you make of? What did they do? What are their numbers like? More importantly,
Yeah, TDK. Actually, there's a story behind that. I'm a big fan of Ajax, as you guys say it probably, and we say Ajax.
I know we call him Ajax. We
You
call him
also call them
Ajax.
Ajax. Good,
Yes.
good boy. Sorry, Ajax. So I have to switch on the Ajax. Okay, they used to have like the shirt sponsor, which was TDK, and back then
Okay.
they were known for like videotapes and like this kind of stuff. And it's actually a very old company. They're around since the 30s.
Okay.
And that's basically where they started at. Nowadays, they're way bigger in things like batteries and sensors and all that kind of stuff. They make the most money from the batteries, and that goes mostly into like cars, but also into handhelds. So that's where they make, and a lot of that is sold to China. So that's pretty interesting to see. Um, when you look at their numbers, I think it's like 70-80% of their sales are going actually to Asia. So
Oh,
that's
okay.
like China and the rest of Asia. Only like 8% is actually Japan itself and America. And that's very interesting to know, especially with the tariffs going on right now. It's only 6.4% of their sales. So that's pretty interesting to know. When we go look at the numbers, their current yield right now is about 2%, a little under 1.9%, with a payout ratio of about 34%. So that's 30 yen that they're paying a share. And they've been managing to grow this by about 17.5% a year over the last 10 years. So that's even been picking up because the last 3 years it's been 24% a year that they raise their dividends. And that with a debt equity to equity of 0.3%, 30%. So I think this is one of those companies that's growing their dividends really fast. And it's supported by their revenue growth and earnings per share growth. So it looks very healthy and a very interesting company to me.
Yeah, yeah. I mean, they have a partnership with McLaren as well, which I thought was quite interesting in Formula One. But yeah, you're right. Their dividends their growth has been really, really strong. It was around HN back in 2016, 30 yen at the moment. The payout ratio is only 30%, so it's still quite low, even with these high dividend increases. And I was trying to think of a competitor for this type of company, and I don't go down to this level in my line of work, but I am familiar obviously with capacitors, inductors, batteries, lithium ion batteries, and so on. But I was trying to think of a pure play competitor for them, and the only one I could think of was Mitsubishi Electric, who do some of these kind of parts. I have heard of TDK before, but I can see why they're so big and so vast, and I'm surprised that they sell a lot of their stuff more so in Asia than the United States. I would have thought the United States would have been a bit bigger. So it looks like there's plenty of room for expansion, I would say, in that area. But if they're selling to Asia, we buy all the stuff from China because it's cheap. So these guys must be cheap.
Oh yeah, but I think, I mean, it's not like tariffs won't hurt them. Of
Yeah,
course, the stuff that's being used in China is going to be sold in America, Europe. But it's good to know that at least they're first look they're not going to be hurt too much by all the tariffs.
yeah.
And what's another thing that people should be aware of? If you're buying, at least that's with my broker, if you're buying in Japan, you have to buy in 100 share lots.
Okay.
So especially if you're a small time investor like me, and a share price is very high, it means that you have to spend a lot of money to be able to buy them, unless your broker allows like partial shares or to be bought. And the good thing about TDK is that they did a 5-to-1 split lately, which
Ah,
means that you can now pick up 100 shares for about €1,000,
yeah.
which makes it affordable. I mean, compared to a lot of other Japanese countries that you have to spend like €10,000 or whatever.
Yeah, yeah, and it's a big difference, especially as I would say, a small time retail investor. I mean, you can't always be. You got so many risks involved. Obviously, they're in a different geographical region. You got the currency risk, which is different, and then, as you said, having to buy in 100 lots. is also a big risk, especially if the share price goes up and down. It'll take a big chunk out of your portfolio. So quite interesting to know they did a 5-to-1 split on that. But what I will say about this type of company is that everything you use, everything we're using right now,
Mm.
needs these products. I have a PC, I have monitors, I have a webcam, I have a mic, I have headphones. They'll all need some sort of sensors, inductors, capacitors, power supplies. There's something in all of these devices, and we all know electronics is it's going off the scale. Like everyone has maybe 2 or 3 phones even at this stage, and electric cars are coming on the scene. We spoke about McLaren racing. Um, that's moving to electric at some point as well, apparently. So, yeah, I mean, you can see where the growth will come from a type of company like this. It's just a shame that they're on the Japanese market. I think if it was trading on the US market, I probably would look at them a little bit more, I would say.
Yeah, because what's stopping you exactly from like buying a Japanese stock? Is it the lack of news, or is it?
Yeah, it's a multiple things. So one, it's an additional currency. So at the moment, I have euro, I have US dollars, and I have Great British pounds. That's primarily what I have. And actually, I have Evolution Gaming. So I know I've got the Swedish krona. So I've got 4 different currencies. But you hear a lot about them in our particular news because it's close to all Europe. Japan, then you kind of have to go out of your way to read the news, to find articles about this type of company, to even know when the earnings are coming out, and then the currency risk. And then also, as you said, buying in 100, because my broker's saying buying in 100 share lots. I would do that with companies I'm 100% convinced in. But I don't know if I am like that with Japanese companies. So yeah, there's multiple reasons why. But do you know what? If there was an ETF, it would be worth looking at if I had these types of companies. It would save me a lot of hassle. But ETFs in Ireland are also kind of like a taboo with this deemed disposal rule. But I think ETFs, if I was investing in that region, I would prefer to go an ETF route than individually, I would say.
Yeah, okay, makes sense.
Yeah. And then the last company on the list, and I love the name. I have to say, I love the name. When I saw this company in your portfolio, I was like, we have to talk about this. It's a Canadian company, so close to America, I admit, and we have spoke about Canadian companies before, but never this one. And the company is called Decisive Dividend Corporation. Now, I mean, that must mean they love paying dividends, right?
It sounds very decisive. That's what I like about it. Oh yeah.
But I mean, it's got a very, very unique business model, I would say. I don't know who you follow on Twitter, but there's a girl called Cody Sanchez. And I have to say, she's very engaging, very, I would say, when you watch her videos, captures you in. And she speaks about on Twitter about all these boomers or people around that area now coming to the end of their business cycle and wanting to have a business and trying to offload these. And that creates an opportunity because people like me and you can go in and take over. Like she gives the example of a garbage truck business and becoming a millionaire or so on. And Decisive Dividend Corporation kind of work in the same line business model, don't they?
Oh yeah, yeah. They're very acquisition driven. They actually have. If you go to their website, one of the things that really caught my eye is that they have this like portfolio description, and next to it is selling your business. So, and if you click on that, basically it's exactly what you're saying. You know, they're saying, hey, if you got a manufacturing company and it's profitable and it's established, you know, and sell it to us, a bit like Buffett does. You know, we'll take good care of your company and we'll just add it to our long list of portfolio companies. And that's basically what is their business. You have to imagine it's a small company, and I mean Decisive itself is about 150 million,
Yeah.
I think, Canadian dollars. So you know, it's a different ballpark from what we were discussing before. It's a small company. So the type of companies that they are acquiring, they are more like the pop and mom business, like you said. You know, probably something like the bigger ones are like 15 million. So that's already like 10% of their like market cap. And then there's a lot of like smaller ones, like 7, 8 million. So that's what they are basically adding to their portfolio, and with all the profit that's being generated, that's what they pay their monthly dividend, and
Oh,
that's what we like.
we spoke about annual dividends, and I mean, come on, who doesn't like monthly dividends? It's why we love realty income. But But talk to me about that dividend. What's the dividend growth like, or is it even safe?
Well, the last 5 years, the dividend growth is about 8%.
Okay.
And when you go to their reports, they claim to be paying about 88% of the earnings. So it appears to be safe, but on the high end. And it doesn't surprise to see that it's also has like a yield of about 7-8% usually.
Yep.
So the yield itself is also pretty high. So it's you could say it's an income stock, with a high payout ratio. Their debt to equity is on the high side with 130%. So you have to be aware of this. But it's one of those companies that just tickles me, and I'm just prepared to take that risk.
Yeah, I mean, for a small cap company like this, I find the business model very, very interesting, especially on the back. As I said, I follow that Cody Sanchez person. I have a book. It's an interesting take. It's an interesting business model in terms of, yes, there is a lot of business boomers now coming to retirement that want to sell their business. And the younger generation is lazy and probably don't want to put in the hard work of being owners. And I put my kids in that. And maybe I'm going to put myself in that too. But yeah, I do see the merits behind a company like this. Has some risks obviously associated with it. And when you're buying or acquiring, there's probably going to be a lot of goodwill on the balance sheet unless they're getting them really cheaply, which they may do based on who they're buying them from. So there's a lot to look out for in a company like this. But I think it's a small cap, a small position, a portfolio, a high dividend yield, as you said, with decent dividend growth. It looks like a solid option. So there's plenty of good companies in Canada. We talk about Canadian banks, but I don't think I've ever heard anyone talk about Decisive Dividend
Oh,
Corporation.
whoa,
And
whoa! Be aware
go
of
on,
what you're saying now.
who has
Our
this?
friend Alan.
Of course, Alan does.
Now, Alan, he's the guy
Yeah.
that likes to take a little risk. But also, he bought this not like last year, well, the year before, but like a couple of years back.
Wow, I'm not surprised.
And he's actually he acquired quite a few shares in this one. I think it's his best dividends payer. Like it pays him the
Wow.
most dividends of all his stocks.
Yeah.
So, and I can imagine if you were only paid like 1/3 of what it's worth now in share price, if you've been adding regularly, this could be a really well payer.
I mean, I'm not surprised that Alan has this in his portfolio, first of all, because his strategy removes any emotion. There's no emotion in buying stocks. He has a set of rules and he sticks to it. And I would say he's a mini ETF, but he's probably a major ETF at this stage with the amount of companies. But the benefits of that, obviously, is that he has a criteria set of rules, and you uncover hidden gems. I would say like this. So congratulations, Alan. I'm not surprised you pick a gem like this, but could you imagine buying this company 5 or 6 years ago? You might have made his money back already.
Now, you know what the 5-year CAGR is? Share price?
What is it?
41%. 5 years, 41% a year. Wow. Wow.
Yeah,
That's a real well done, Alan. Really well done.
yeah,
And that's a good point that you're making, because that's what I was actually when I was preparing a bit for this show or podcast. That's what was coming to mind. I was like, if you have a really big portfolio, I have 120 stocks. Sometimes I'm like, that's crazy, but it does allow me to buy these type of stocks, which I would not buy if I had only like 25 stocks, because
yeah.
then I would rather go for quality, steady eddies. I don't want to get any dividend cut. But if you once you reach the point that you have like 100 stocks, one dividend cut won't hurt too much.
Yeah, yeah. We spoke about this a little bit off air, and you shared with me your portfolio. And the first comment I made to you was, "Wow, you're like a little mini Allen." was my first comment. But there were some like companies in there that I go, "Wow, yeah, I like that company." But like you, because my portfolio is a little bit concentrated, I wouldn't add them to my portfolio. But now I say that, but my portfolio is creeping up now. I think there's about 45, 50 companies on that now. I did get there before and I trimmed it back, but it's so hard because we constantly look at companies and stocks and you're adding a couple of shares here. And at some point you kind of go, "Oh, maybe I don't need to be sitting there looking every quarter at my top 10 positions because, and the way you had it spread out, I mean, maybe it's your top position is 2% of your portfolio. So it's not going to move the needle if they cut their dividend, if they go broke in the morning, if they go to zero. And there seems to be a lot of merit to that type of investment style. And I have to say, Alan shares his report quite regularly on our social media platforms, and he could already retire from his investment styles. We know it works, we know it's successful, we know it can uncover lots of dividend gems like Decisive Dividend Corporation. So it seems like a good strategy, and it's one I've been pondering with quite a while.
I have a suggestion actually.
Go for it.
Let's say you don't want to get to the 100 stocks like I do.
Yeah.
One of the options that, of course, that you have is when you run into one of these stocks, why not make it into a pie? Make it into a 2-1-2 pie.
Yeah.
I did it actually for my pharmaceutical stocks. I find it way too hard to decide if J&J is the best or which ones I should pick. And I don't want to own 10 individual stocks. So what I did, I just made my big pharma pie, added some stocks to it, and now it's one position in my portfolio through one pie. So basically what you're doing is you're creating your own ETFs. And I've been thinking of doing that with they're always too expensive companies. You know, the ones that you really, really want to buy and you want to own, but just they're always too expensive. Why not just make a pie and say, okay, I'm going to add like 20 of these companies and scratch the itch. I'm just adding them.
So it's funny you say that. I do have a couple of pies. So one I have is the Dividend Talk one. I have that one. I have European DGI's Noble 30 Index as well. But I also have one for engineering companies that I really like, but I feel that are overvalued. So I put them into this pie, and I actually don't even count this towards my. It's funny. I feel like it's like a fun part of my portfolio. I don't count it. I don't count the dividends received, but I have like companies like Rockwell, Schneider, loads of different companies. So I think there's about 20 companies there, all engineering based, all companies that I personally use. Keyence are not on it, by the way, but all companies that I use, and it's in this pie, and it's just $50 every month goes in and does that. So I do have that. I just don't report it, talk about it, or even do you know what? I don't even open trading 212 at all. I always look at Interactive Brokers or the Euro.
So I actually got a scoop from you today.
Yes. You got that one out of me. So that's always an interesting way of doing it, and classing it as one position, just whatever you can call it.
But I think it's actually a tip to listeners, especially those who are new to the investing. It's sometimes for a lot of people, they have like this you call it play part of your, like, the playing part of your portfolio, just a small part of your portfolio where you do the things that maybe should not do, or it's not the smartest thing to do, and just play with it. Just scratch that itch. Just make sure that it's not too big for position.
Exactly. And you're not overextending yourself. As you said, I do it with 50 euro a month. It's not going to kill me or anything, but it's like you said, it's to scratch that itch and to have companies that I enjoy, I have to say. It's companies I like. So it's good advice. I'm glad you said it. I'm glad you brought it out of me as well, but it's very, very good advice. So there were our 5 companies. So just to recap the companies again, just for our listeners. So we had 5 altogether. So we had KRKa from Slovenia. We had Keyence from Japan, Verbund from Austria, TTDKY Corporation, also from Japan, and Decisive Dividend Corporation from Canada. So safe to say we don't speak about many of these companies often on the podcast, but one thing I have learned about doing this podcast and putting out the question is there is lots and lots of hidden gems, especially in Europe and in the eastern parts of Europe that we haven't got to. So Finland, for example, Norway, there was loads. Romania had some. So there's lots of companies for us in Dividend Talk to keep talking about. So gives us plenty of material for years to come, I would say.
Oh yeah, we could do this episode like 10 times more and you would still not be running out of stocks, for sure.
Exactly. We have a couple of listeners' questions. I did try to post this on Twitter, but Twitter had some issues, I think, on Friday. So I had it scheduled. It never went out. Then my own internet, so we were supposed to record this yesterday evening. They decided to cut a cable not too far up the road, so we had to postpone it to today. So we got a few questions on Facebook, so we'll run through these quite quickly if that's okay with you. And Peter has asked, which markets would you definitely avoid and why?
Personally, I avoid anything that I don't necessarily trust the government. You know, things like China, Kazakhstan. I saw one of the questions was about Kazakhstan or a Kazakh company.
Yep.
Those are a bit more too much to me, like the wild, wild east. You know, if I can't trust the governments, then I'm staying away. And besides that, it's well, certain companies like banks, you know, that I'm just not. That's not about regions or markets.
Yeah.
That's more like individual company. But that's basically the reason. I have to get a feeling that I can trust the governments to not just, you know, snatch away a company or yeah.
Yeah, it's one of the big things, and like being from Europe, I suppose we have it. I would say relatively easy in terms of that. It's relatively transparent. I would say governments can get involved. We've seen that during COVID, in times, particularly with the French companies and the pressure they were put on to cut their dividend, for example. But I always feel the risk with China, and that's why I struggle with Chinese companies, is greater than that. I mean, they could just take a company out of existence quite quickly. I know the CEO of Alibaba, for example. There was rumors that he had to go underground and into hiding. And look, that's all speculation, rumors. I don't know much about it, but again, it just reinforces to me that I don't know this market very well. I don't know the government very well. Um, so I I'm like you. I tend to stay away from areas where I don't know the go. And trust is a big word, but I don't know the governments or the policies or what their involvement is in companies.
Yeah, that's exactly. I think there's something to say. You have to like separate like markets that are very fast growing. For example, like India, China. I mean, I can imagine that there's a lot of population. You know, they're going to get a richer there. It's very interesting as a market. Absolutely. The same is a bit with mining. For example, uranium, all these things. I can see that there will probably be a market for it, but I'm still staying away because I just do not trust the place that they have to do their business.
Yeah. I think as a retail investor, we have limited access to information, especially in those regions. So we're relying on what's left out on the internet, I will say, what's out there. There's probably money to be made in those areas if you maybe live close to there or are an expert in that area and have maybe insider knowledge. But I think as a retail investor, we spoke about this briefly earlier, not having access to news. And I think that's probably one of the biggest things as well with these. You're limited in terms of the knowledge they give you. And that makes it so hard as well. So yeah, I like to stick to what I know. It makes my life easier. I can sleep well at night. That's
Yeah, but it's a good thing that you said that because if you are listening and you're like really knowledgeable about an area that we do not like, you know, go for it. You might have an advantage over us.
yeah, yeah. I listen to money makers. It's about investment trusts. I have some of them in my portfolio, but I can't remember the guy's name, but he's in the emerging markets and he does quite well. But there's lots of these little laws, like he's in say the Philippines and all this, that me as an investor I would never know. But he's given away nuggets of information that you can only invest this amount or you can't invest in this type of company. But he obviously knows the market very well, so he can make money. So I would trust my money in an investment trust to do that. But I mean, if I was to do that, I'd just lose money hand over fist because I just would not know one thing about their laws or anything. So yeah, I think invest in what you know. If you're comfortable and you know the area, you know the markets, go for it. That would be my advice. Thomas has asked us about Polish companies. So one of them is, I'm not even going to try and pronounce the full Polish name, but it's KRUK, I think Kruk is the abbreviated version of the name. It's a Polish company, as I said, and it looks quite strong, but I don't know if you know the company. He's also asked us a secondary question about the Polish stock market in general compared to the S&P. It's doing quite well. So do you know anything, first of all, about Kruk, and what are your thoughts on the Polish market?
No, I don't have anything useful to say about Crook, to be honest. I think I read about them one time. I did end up not investing. but it could be a wonderful company. So I'm going to leave it at that. About Poland itself, I think it's one of those countries that's up and coming in Europe right now. Their stock index probably needs some time to grow up. It still feels a bit like it needs to strengthen and grow. It's still early days, I think, for them, but it's a very interesting stock market. And I used to own Ambra.
Yes.
You know Ambra. I think European DGI also owns it.
Yeah.
And this is something I'm gonna just side mention. They have a parent company,
Yeah.
and it's based in Germany, Schloss Wachenstein, if I pronounce it correctly.
I'm not going there.
No, it's one of those hidden companies. Schloss Wachenstein, people look it up because the funny thing is they have the same market cap as Ambra, but they own 60% of Ambra. I did
Okay.
not dig into the numbers, but hey, there could be some value there. I'm not sure. It also pays a dividend of about 3-4%, I think. So could be an interesting side step for people to look up.
What's the ticker before you move on? Just because I won't be able to spell that.
Let me look it up. Just a second. Almost there. I have it in portfolio, by the way.
Yeah, I know.
So that's probably why you asked me the ticker. Oh, let me see. I should have had this prepared maybe, but it's SWA in Germany.
Perfect. Yeah, that was a nice little side step. I did see that in your portfolio, which is why I asked you. But I think part of the first question is KRKa. I looked at what the company does, and it engages in the management of debt, which I always find quite risky. Look, it's in credit management, and so you really have to know what you're investing in. So I might not be overly keen on this type of company, especially when it's not in Ireland or the UK, because I'm more familiar with these types of markets. I did look at their dividend growth using FinChat, and I don't see any dividend growth. So I don't know if it's only newly paying a dividend. I don't know, but there's nothing there for 3, 5, or 10 years. So maybe it's a relatively new company.
Could it be an income stock?
Could be. It could be. But it doesn't have a payout ratio. Now this is FinChat, so I haven't gone much deeper than that.
Right.
I've seen their earnings growth and the revenue growth is quite strong. Earnings is over 5 years 51%, and their revenue growth is around 15% over the same period. So I could see I can see why you'd like this, but from a dividend perspective, I don't see much information on FinChat. And this might fall into what we talk about, information in certain markets, and when we don't get it. But in terms of the Polish stock market, I mean, from the outside looking in, it looks like Poland is the up and coming powerhouse of Europe. It just seems to be, anything I see on media is positive. I've been there, and I had an amazing experience there, and it felt like Ireland felt to me back nearly during the boom. Everybody's happy, it's bustling, and it feel good. We feel good factor around the place. Infrastructure was great, people were great. So yeah, it just seems like it's like I hear negative news about Germany all the time, and France all the time, and England all the time. Positive news about Poland. So it does seem like it's up and coming, and I'm not surprised to see that their index is up 30%. They have some really strong companies on that index, and yeah, like you, I still think it's quite young, but it's definitely an area that's probably worth looking at a little bit more. I know there was trouble. We spoke about governments, and I know the government there has not always been shareholder friendly, from what I gather, anyway. But that seems to be changing. That sentiment is changing completely over there. So, yeah, I think it's definitely a region to give a little bit more attention to.
Yeah, I just looked up some of my transaction history, and I think I've invested at one point in Mobruk,
Oh yes,
MOBRUK,
yeah,
which I think is also Polish.
yeah, nice. Peter has asked us to look into a ticker REXR, Rexford Industrial REITs. And I thought this was an interesting question because, again, it's on your portfolio list. You've got 120 companies, so it's probably hard not to find the company not on your list. But look, they have a nice dividend yield. Apparently, they're fast growing. It's got a very safe rating from Simply Safe Dividend. Love to hear your thoughts on this type of company.
Oh yeah, I've owned it, and it's in the minus. So that would imply that it's actually only cheaper than when I bought it, and I should like it more, which is actually true. What's interesting about them? It's obviously an industrial REIT. So, but it's also focused in California, and especially the southern part of California, which is close to Mexico. So basically, that's why it's what sets it apart from other industrial REITs.
Okay.
And as you know, Mexico is growing fast, and they're doing a lot of business with USA. So maybe depending on the tariffs and what it's going to mean for a company like Rexford Industrial Realty, will they, be hurt by this? That's probably why the price of the share dropped lately and why it's so negative. But if you look at their numbers, it's really impressive. I mean, they're only like 15 times FFO, like so that's
Okay.
it's not expensive at all. It's yielding about 5% right now, and it's been growing like the last couple of years for about 15% a year. Their dividend, so their debt to equity is like 40%. So it's not indebted. It should have enough room to grow the dividend. I'm very positive about this company.
Okay. So you agree then with the sentiment then that it's a fine yield, fast growing, and dividend is safe.
I think he's a wise man.
Yeah, yeah. Peter. To be fair, I follow a lot of Peter stuff on our Facebook group, and there's not many things he says that are, not many companies that he mentions that are not good companies. So yeah, I'd agree. I haven't looked into the company, but it does look interesting, and I was happy to see it on your portfolio because I didn't have to look it up then.
I think if you're looking for a REIT that is focused on industrials, this is probably one of the better ones to buy. Yeah.
Yeah, yeah. And it's interesting you mentioned Mexico as part of this and how fast growing it was. There was I was looking for a dividend company there, and I came up with some airport company in Mexico. But again, it's one of those markets. I don't know about you. I wouldn't trust the government there, so
Yeah. Yeah.
yeah,
Exactly this. Yes.
so it's quite tough. But you get a benefit of a little bit of Mexico, but from US government policy. So why not? Paul has asked us about Kazan Prom.
Mm.
This is the, I definitely said that wrong, right? But this is the largest uranium producer. And you touched on this earlier,
Yeah.
but your thoughts on
Yeah. I
this?
looked it up and noticed that it was a Kazakh company from Kazakhstan. Um, and to be honest, every time I hear somebody asking me about should I buy this company from Kazakhstan, it's the WeChat from Kazakhstan. I think I heard one of those coming by lately. I'm always like, yeah, but it's from Kazakhstan. To me, it's really like the wild east. This one is a uranium stock. I'm not sure producer. I'm not sure. It could be very interesting, especially as you said with before. We need reliable sources of energy. One that can go 24 hours a day.
Yep.
Uranium has a part to play in that. So again, this could be one of those big opportunities. But then again, I just don't like the environment that it's happening in Kazakhstan. Sorry for
Yeah.
the Kazakh people. I love you guys. Just don't trust the government. Sorry.
Yeah. And the fact that it trades on the LSE, would that change your mind at all? That it's trading on a,
Not at all. Not a
not at all.
bit. No.
Yeah. Yeah.
There's a lot of African companies, for example, also trading on the London Stock Exchange. I would not touch them.
Yeah.
No, too
Yeah.
risky for me.
But I mean, the thing about uranium is that, well, we spoke about renewables, but what we didn't mention is uranium is massive in the production of nuclear.
Yeah.
And nuclear energy, I mean, you spoke about reliability, we spoke about wind, solar, but nuclear blows all this out of the water. And if we can produce that safely, is the key. Nuclear could have a big part in our future. So I can see why this type of company is very interesting for people. And I think it will have a large part to play, especially as the largest producer in the world.
Mm.
So, yeah, I think it's a company to watch. But again, like you said, you have the issues around the control of the company and what happens to that. So, if you're happy with those risks, it could be a decent company to look at. And then finally, Andrew has asked us about a company called JD.com. They have a dividend yield of just under 3%. They've got a 25% CAGR. They've only been paying for 3 years, by the way, and they've bought back 8.1% of their shares last year. What are your thoughts?
I thought their yield was lower than 3%, or did I miss something?
We can check that, but while you're looking that up, maybe I'll give some background into the company. So JD Sports or JD.com, so they have companies here in Ireland that I remember, and when I was growing up, they'd sell the same as like your Nikes and your Adidas and all these types of products, similar to what we have in many retailers across Europe and Ireland right now. But lately, these seem to have become some sort of, I don't know, high quality. I was saying high quality in investment and like in quotes here, right? But for the youngsters of today, this is like a high quality company. They won't shop in the places where I get my Nikes. They go to JD.com, right?
Oh yeah.
And they cost me a fortune. I've got 2 teenage kids. They have these tops. Monterey is one of the brands, and it's just incredibly expensive. Like Ireland is relatively small, so I don't know if it's the same in Europe, right? Comparatively speaking, there's only about 5 million people here, right? But this is massive with the younger generation. Everybody's wearing their gear. It is everywhere, and if it's the same trend all over Europe, I can see why the interest is there in this type of company. But for me, growing up, I would have saw them as like low quality, probably a cheaper option of buying products from, and we knew there was like a Chinese element to it. So it definitely wasn't as big in my generation, but my kids love it. Which is bad news for me because my wallet absolutely hates them.
Well, I recognize, first of all, I recognize what you're saying. I see a lot of youngsters walking around with bags saying JD on it. It's probably because it's a Chinese company, as you already said. It's headquartered in China, which for me personally, it makes it a no-go.
Yeah,
But their yield is very much, it's on the low end at 0.4% with a payout
yeah.
ratio of about 24%. So, and I don't see much of a history of dividend growth. I'm not sure if that's...
I see. Well, in fairness, Andrew said they've only been paying for 3 years. I can see a 2-year dividend growth rate of 4%.
That's why.
And they pay out around, in Chinese yen, they pay out about seven in that. So, yeah, for me, look, the yield is far too low to be interested. They've got a short history in paying out dividends, and this type of company, as I just spoke about, you talk about cyclicality, but in the fashion industry, it can swing and quite significantly. And a company are definitely products that I wouldn't have touched when I was younger are now popular, but that means they can go unpopular just as quick with a newer generation coming up. So I don't know about owning them as a long-term hold, but definitely off the bat, dividend history is not long enough for me, and the yield is far too low to be interested. Okay. Thanks to everyone for all the questions. Apologies for not getting it out on Twitter. As I said, technical problems prevented that, but do appreciate all the questions. And finally, to you, DazMikey, thanks so much for coming on the show. European DGI was going to rush back and record this on Sunday night, but I thought it was best just get someone else to join me. Get someone else who's Dutch. We keep the Dutch-Irish influence going on here and have a bit of fun. But I thoroughly enjoyed this. Your knowledge is off the charts. You've got some really outstanding companies in your portfolio. We could have spoke, I think, for hours to go through your portfolio. But listen, thanks so much for joining me today.
Well, thank you back. I enjoyed the talk. It's always fun to talk about dividends, so I enjoyed it very much. Thank you.
And to our listeners, we shall see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.